All right. Hi, I'm Matt Sitter, CEO of AFN. Great to have you guys here. As we talk about in AFN all the time, change is where opportunity happens. Best way to find opportunity in change is a network that is diverse in experience, expertise, and perspective. Our events are intended to bring together experts with company leaders in our community to expand knowledge on certain topics that are going to help us run our businesses better and to expand our networks themselves. Today, we're talking about corporate venturing and its cousin, Venture Studios, with two great experts, Brad Lunn and Greg Cangialosi. So very excited to have these guys here. Brad founded and leads Blue Magic. That's a global corporate venture capital initiative at General Atomics ASI. They seek to innovate globally and domestically. He's got deep M&A experience and led the IPO at Qualcomm. And he's been doing the corporate venture capital thing for a long time. A lot of great experience to bring in there. Thank you, Brad. And Greg leads Olive Ventures. Olive is a venture studio focused on health innovation. Greg's a multi-time founder and entrepreneur, and he's been experimenting now with the other side of the table in terms of helping entrepreneurs get their businesses rolling. So great to have you guys here. Thank you for coming. And I'm going to give it to both of you guys for a couple minutes on thoughts that you want to give on what you're doing. I know that the funding environment has changed somewhat recently, but that doesn't apply in quite the same way to you all. So Brad, why don't we go to you first and you can give us some of your thoughts.
All right. Well, let's see. So Matt, thanks for the introduction. Let me see if I can share this desktop. It says unknown.
Always a couple technical difficulties, right?
Unknown. Okay. Well, it's asking me to authenticate to share. Yeah, so our security is not allowing me to share this page here. So let me just walk you through it. So we run a corporate venture capital here, and Matt, you had asked me to give some background on what is really the deal behind corporate venture capital. What does it do, and the like. And I think what's really important for folks to know, just in a nutshell, is you have to really kind of know why companies like ours, a large incumbent company in our marketplace, why we would do venture capital work. And in the end, it's really about the challenge of innovation. And the challenge is that larger companies find innovation to be really difficult. We have a threat of new entrants that come from outside of our marketplace. These are really big risks and really dangerous. And so when as an example, Boeing, Lockheed Martin, Orbital Sciences, United Launch Alliance, they were out innovated by a newcomer, an unheard of company, startup, SpaceX, that tried to do some things in a different way and at a completely different cost point because of how they were doing things differently. And those large incumbent companies found their businesses really wrecked as a result of it. And, there's example after example, from automotive to cameras to you name it. Every industry has this kind of a problem. And so what we try and do is use corporate venturing as a way to inject innovation into the company and use that. It's usually faster than trying to do it on your own, where your own corporate culture could end up stifling that innovation. Now, what you really have to know about corporate venture capital is that when you're thinking about corporate venturing and venture capital in general, there is a continuum of the objectives of those companies, and they range from, on one side, to just purely financial oriented. So these are folks who are just looking for ROI They're thinking in terms of the term of a deal is short. They like control, and they are thinking about how are they going to exit this deal. Are they going to merge it out? Are they going to sell it? What are they going to do with this thing to monetize their investment? On the far end of the opposite end of that spectrum are the strategic investors that have a longer term, that control and exit is not the dominant theme, and it's really about innovating their products, processes, and business models. And you will typically, not always, you'll typically find traditional venture capital will lean on the financial side of that continuum, and corporate venture capital will tend to lean towards the strategic end of that. And so not only do corporate venture capital folks bring money, but they also bring a lot of things that companies may find more important. They could become a flagship customer for that product. They can be doing testing. They can give immediate technical feedback on things and basically help that company to be successful. And in the end, what we try and do is to pull the risk out of these things. We either want it to succeed or to fail. We just want to know what that answer is as quickly as we can. And so speed is important to us on that. And so that's where a corporate venture capital partner can do a lot of this. So basically, it will have a very different feel from traditional venture capital. Now, both can work together really well. I work with traditional venture capital companies every day of the week, and it can be a good marriage. Both of us can get what we want out of it. So in any event, that's kind of what is behind corporate venture capital.
Awesome. Thanks, Brad. And Greg, any additional thoughts that you'd like to say just with the Venture Studio spin?
Yeah, I mean, thanks, Brad. That was great. Yeah, and just to maybe just frame it up a little bit. So in a different kind of aspect of CVC, we're a venture studio that is an off-balance sheet investment, has been the last 2 years, to our parent company, Olive AI, which is a healthcare automation company that helps automate the mundane tasks that healthcare workers go through. I mean, if you think of the industry that we work in, it's a $3 trillion industry on an annual basis here in the United States, with $1 trillion of that attributed to administrative, basically waste, we'll call it. Okay, I don't have to mention fax machines and other things. It's like healthcare doesn't have its own internet, so there's a lot of challenges a lot of challenges in general in the industry. And so, from the venture studio perspective, unlike traditional CVC or corporate venture capital, what we're doing is the reasons why are we have a faster trajectory to de-risk ideas, speed to build them. We do it for innovation reasons, obviously, and then most importantly, our parent company has distribution into a very challenging industry called healthcare, where Olive's technology is deployed across over 1,200 hospitals in the U.S. Some of its customers include 60 to 70 of the largest net billion-dollar patient revenue healthcare systems in the U.S. And so what that provides us is a platform of distribution to be able to look at other areas in healthcare that Olive's not going to get to, that need innovation, that need solutions that are big enough to warrant standing up net new companies. And that's what we do. We will take off balance sheet a team of 15 people. We have between 15 and 20, it fluctuates, and we act as the co-founders. We take an idea, we vet it, we make sure the problem is big enough to solve, we make sure there's a big enough TAM there to warrant our investment in terms of our time, money, and resources. And then we marry that idea with a founder. That founder can come within our parent company, come from outside the parent company. And in some cases, it even comes from our investor, our capital network, for someone who's looking for kind of their next thing, sort of an EIR, if you will. And so that's what we do. We've been proving this out for the last, like I said, 2 years. We've launched 6 companies. Some really cool high level stats I could tell you about our performance on what we've been able to do. From a start to seed, our companies average 4.75 months to their seed round, and those seed rounds I should be really clear, don't come from us, right? Our investment is we start the company, they pay for our OpEx to get this team up and running. We employ the founder, we bring them on as a full-time employee, and we leverage our team to help them get to inflection point one, which is building their minimal viable product, piloting with a healthcare system, and then eventually to an inflection point of a seed rounding before they go out on their own. Obviously, we take a healthy equity stake at the parent company, but we are very founder friendly. We leave 70% of the equity to go to the founder because we want to see them succeed. So it's been really interesting. Once we get to a point where, it's working per se, and everything's been validated from a pilot perspective in its particular sector that it's solving, we will then play matchmaker to our capital network. And our companies in the last 2 years have been funded by Google Ventures, Drive Capital, First Mile Ventures, and some other firms out in the West Coast. And right now we're tracking, going back to speed, the average company takes about 10.7 months to get to their seed round. We're doing it in 4.75, just under 5 months. Series A, we're tracking 12 months versus 25 months. So there really is a dramatic compression in timeline to get that innovation and to be commercialized. So a little bit of a different, it's a little bit of a different take. It's still coming off balance sheet. Similar reasons, innovation, but also in an industry, there's just so many problems to fix. Healthcare is very broken.
Right. And maybe so pre-seed is pretty much where you're living, Greg, in terms of getting where you're getting the initial idea going. Brad, what stage of company are you guys looking at?
Primarily from seed through Series B, although we also do work with established companies that are public.
Okay. And so ultimately, it sounds like, Greg, you guys are looking for these guys to be able to stand on their own. Is a goal at General Atomics for some of these companies to become a part of the GA family, or do you want them to stand on their own as well?
Well, ideally, they would stay on their own. We really want them to be a viable, healthy, growing company. And we take a little different approach on how we do investment. By and large, we don't take an equity stake. Remember, I have to compete with a lot of other corporate venture capital, and I don't write as big a checks as, say, my friends at Lockheed Martin Ventures or Boeing or Airbus. And so what we do instead is we release a contract, and then if we can get the technology to work as intended, then what we do is we carve out our space in it, and we have a protected market space. So we will be the only innovator in our market space. So they're free to innovate outside and sell to others, but they're not going to be selling to our competition.
Okay. And so, is there a reason why you don't want equity in these companies?
Because, well, one, if I take the approach that we take now, I can get everyone to prefer to work with me over everyone else, because I don't take a big swath. They only have 100 points to give away, right? And it doesn't bother me if they become a billionaire.
So you're sort of like locking in the innovation into your parent company.
That's right.
And putting up the moat, so to speak.
That's right.
Very cool. Yeah. This different approach. This is why this topic is so interesting. It's like,
well, I had to innovate how we innovate. So our innovation is this.
That's
very meta. Very meta.
That's very interesting.
Yeah.
And Brad, I can tell you, so when we do this globally, and so when we work with other, let's say we sell product into country X, we have $1 billion transaction into country X. That country wants us to do some work there of some kind, and so what we do is we start hunting there for venture companies to invest in. And if I can explain how I don't take their intellectual property, how I don't end up taking the founder's equity, and I can inject capital and know-how in a kind and gentle way, they love that. Where you have the same discussion with other big aerospace companies, and they're going to be doing it in a more traditional way. Ooh, that's a bristly pill. And so we get love and embrace from everyone we work with. And so it's a good place to be.
Can I ask a question from that?
Yeah, go for it, Greg.
I'm just curious, Brad, because that model is really, like I said, it's fascinating to me. It's the first time I've ever heard it.
Yeah.
If you don't mind sharing, and if you could, and if you can't, I don't understand, but what sort of like check sizes are you guys putting in to these companies? You said from seed up. Is it nominal dollars, or is there a range you can give? Just I'm curious, because it's just fascinating not to not have the equity piece, but also to.
Well, we've done transactions that are millions, but I would say by and large they're in the 100,000 or more. But we also pair it with basically partnering. There's what we call the Blue Magic Network. And that is from inside the company, we can help. So for example, if it's let's say it's a company that has a material innovation in composites, we immediately start partnering with them, and we will release to them a CAD drawing that then they can make a part. Then we take it, we will test it for them. We provide all the data back to them, and then we can make our decisions about the use of that in our applications, but they get to use that for themselves. And that may be something that they can't do. They don't have the wherewithal to do that kind of testing. They don't have an airplane that they're building that they would put it onto. As an example, we have test chambers and we have all kinds of capabilities. So like you are basically investing know-how from your parent corp into these companies, along with the employee and the founder, and basically providing a cocoon of workspace to be able to get things done. We do the same in a little different way. And so it's a great partnership.
Yeah, they get to leverage your resources and get access to things that they couldn't get on their
own. And remember, my objective is to help make us more innovative. And so this is a way that I can then pull in other parts of our company into viewing these kind of companies and the like. So the other parts of our org come away smarter. They come away more externally focused, not internally focused, which is what we're trying to get done. And so what we don't want is for this to be Brad Lunn's technology idea. We want it to be the organization's technology idea that is embraced.
Got it.
Does that make sense?
Yeah, absolutely.
All right.
Well, and so Brad, you talked a little bit about where you're originating some of these folks from. Greg, just back to you really quick. So I'm curious as to where the ideas originate in the organization and how you find founders to be able to pull them together. Where do these folks come from, and where do the ideas that they're supposed to be working on come from?
Well, so okay, so that's a great question. So we have what we call a drafting table, which is a drafting table literally of ideas that are in various levels of being vetted, right? No matter what the idea is, it goes through the same process, whether it comes externally or internally. One of our companies, Magenta Care Continuum, was an idea that the CEO of a company that we acquired after we acquired and they got assimilated and integrated to Olive. He was moved over to my team as an EIR, quickly worked with the team at Google Ventures, Dr. Ben Robbins, to look at sort of how they could figure out a better solution for taking medical records and claims data and doing better risk adjustment for Medicare Advantage plans, right? Which is very lucrative and also gets patients the healthcare they need who are at the highest risk and missing care gaps and, et cetera, et cetera. That's one way. That was like a 3 to 4 month process that we did. And what like firms like GB do is they have a bench of like 90 to 100 advisors that work with them. And I must have sat on 6 to half a dozen to a dozen calls with these folks, hour-long calls, kind of vetting it, and validating it before we even moved forward. That's our most advanced company, and most mature. That's getting ready to do their A round. Other ideas that are on our drafting table have come initially from our CEO, and then our team, just market research, looking at ideas. The process mining for healthcare. There's so many different broken processes in healthcare. We've got one called Helia that looks at, from an employer perspective, an employee who's got two incomes in two different families with two different health insurance policies that they could select which one is right for the family. And then they come up with what's called a care credit that it ends up at the net reduced cost for the employer and a no deductible situation for the employee. So really kind of being innovative with the data. And so those ideas, I guess, in just short, they come from either, the original seed for the division and of Olive was our CEO, Sean, some ideas he wanted to do. But then sometimes people come to us with the ideas and we vet them again at the same time, in the same way to make sure it makes sense to invest our time and resources into it. So really they come from everywhere, Matt. But we do try to keep them centrally and we treat each one of them the same. And our only kind of thesis is, in this case, in this studio, it's got to be healthcare focused because that's where we can leverage the power and distribution of the companies that we start.
Cool. Well, both of you guys, I think, talked about speed being valuable. And this idea of, Brad, you brought up binary outcomes. Are they going to succeed or are they going to fail? How are you trying to push the organizations that you're working with towards that answer that you're looking for?
Well, so we do it a couple of different ways. So by providing capital and in some cases, technical expertise, what we try and do is bring them up a maturity curve. There's a TRL level, technology readiness level curve, and it's basically a scale from 1 to 10, and we try and bring them up that curve. And so we try and get them either to demonstrate something in the environment, to be able to demonstrate something on our aircraft, and so we try and take it from being PowerPoints and concepts to something that we can try. So as an example, a domestic firm I found a couple of months ago, we met with them here. They have some very interesting technology. We made some demonstration. We gave that company a chance to do some demonstrations with friendly folks on the inside. This is all under an NDA. And we liked it enough. We went and bought enough of their product to do a demonstration. And so essentially, we are injecting capital into them by buying product, and we will buy it at a high price. So we don't negotiate price on that at all. We know that it's expensive and that's not an issue. And so we are able to get them capital right away, and then we work together with them to demonstrate it. So what we try and do is take it again from concept to something that is tangible quickly. So that's probably the best example. And we hope to fly this probably in the spring. So we made a decision 2 weeks ago. We bought we dropped a purchase order a week ago, and we hope to have this demonstrated by the spring.
What kind of success percentage are you looking for the companies that you invest in?
I don't know that we have really a target like that. We try and make sure that our overall investments are net positive. And a lot of the things that we have to value are intangibles. So what is the tangible value of being the only company that can do X? That is not always an easy valuation discussion. You have to be really honest with yourselves, because it's easy to fool yourself that it's more valuable than not. And so, right now our value proposition is so far off the chart that question doesn't really even arise, fortunately.
And for us too,
go ahead.
For us, it's we're sub 2 years doing this. So I think I said we've done 6. One's fully spun out. One's again getting ready to raise an A round. 2 others have been seed funded, and 2 are like kind of in the percolator of trying to identify who the founders are. And so, but for us, it's start to seed, right? And then we'll commit to a year, right? Up to a year. So no matter what, but we've also found that in some cases, our first company was ready to leave the nest in 7 months. They were on their own. They had $1 million in bookings and were ready to go. That's the only service industry. That's really not traditional for us because everything else is really product focused. So for us, it's, this A round that we're getting ready to see hopefully come into fruition in Q1 is going to be another validator. At that point, everything starts to change, right? New investors come in, institutional comes in, the board makeup changes, et cetera. And then we are now thinking about things like portfolio impact because of our investment and our equity stake in the companies that we literally have started from the ground up. We're totally obviously aligned to keep the companies moving forward and add value in any way we can. We just now have gotten to a point where we're thinking about what does that look like? Is that a separate team? Because sometimes you see venture firms, they have a specific portfolio impact team. Folks like Greenspring, who are now StepZone, they have a whole division that's dedicated to that. But what's really interesting for us, Matt and Brad, is that, and Brad and Matt, some of this, for us, much bigger company, Brad, that you work for than I do. I mean, we're, Olive is, maybe 1,000 employees. It's still a 10-year-old company, but just on a much different scale in terms of size and resources. So what we found and what we're finding is that we need to break off from the mothership and do this independently on our own because we're beholden to a larger company. And if something changes at the company, it could possibly slow us down, right? And so we actually, even the stats that I'm telling you and that we've actually experienced and seeing, think we can actually go faster because we've added 4 people to our team this entire year. That's it. I mean, so we're out now actively trying to raise capital to break this off from the mothership to go faster and do more companies, It's been interesting, but our big mandate was really start to seed and then get it to a position where it's an investable company that can go out on its own and start building its own team around it. There's been a lot of lessons in between that we've learned over the first 6 that we've done.
Yeah.
Well, so we're about a half hour in. We'll open it up for questions in just a second, but I wanted to ask you guys really quick before we go to that. You both made an active choice to do what you do. Just what do you love about what you're doing right now? Brad, what are you enjoying about your job?
What I love is that I get a direct opportunity to shape the future of the company. That I would say that is probably the biggest thrill. One great example that I just really love is that we found an opportunity that ended up being just by luck and happenstance that we found this opportunity, had the right thoughts and observations at the right time, and it actually has changed our mission statement of our company. It evolved the mission statement, and it led to a different series of acquisitions that we wouldn't have made. And to know that directly came from one particular meeting, and then how we not only did we see it, but we acted on it in a way that added value. And so I would say that is probably the biggest one.
Great. Greg.
So Matt, you know this. I'm an entrepreneur. I'm a founder first. In fact, I would like to joke this particular this role is like my first W-2 job. That's not a company I started or invested in and operated either on the C-suite. So what I love about it is I love watching things come into reality and manifesting reality. And more importantly, more specifically, people, I love watching them go out and achieve their dreams. I love watching someone paint a vision and execute on that vision. And so for me, it's really rewarding to be able to work with a diverse set of founders across a bunch of different big problem areas in a massive industry that we're all consumers of, no matter what. That's one constant. Healthcare touches everybody, and healthcare is very broken. And so the mission and part of this is not only is it great to watch entrepreneurs go out and succeed and to help them along the way, but know that we're doing something to advance and change healthcare and innovate in an industry that really needs a lot of disruption and innovation. So that's what makes me enjoy it.
Good. Well, it's definitely apparent that both of you guys like what you do. So thanks for this portion of the conversation. It was great to get that started. And we'll be turning off our recording in just a second, but wanted to thank you guys formally for
Thanks for having us.
You're welcome.
Thank you.